Hello and welcome to this class on common features of financial crises. We will provide a broad overview of the major global financial crises over the past 150 years. Our goal is to understand how the crisis unfolded, why the crises were global, and are there any similarities across these crises. We will uncover these common themes of financial crises. You will see that excessive debt always plays a role. There's always a run on short-term debt, such as bank deposits. Unsustainable long-term investments or government policies often play a role as well. Does a rapid expansion of credit always end in a financial crisis? Towards the end of the class, we will address this question as well. Let's get started. The 5 most serious global financial crises over the last 150 years were the Panic of 1873, the Bearing Crisis of 1890, the Panic of 1907, the Great Depression of the 1930s, and the 2008 financial crisis. Let's consider each of them in turn. This will be a brief description, and remember, our goal is to find the features that come up time and time again. Please try to focus on the big picture and not on all of the small details. The Panic of 1873 was the first global banking crisis. Railroads were the hot investment of the mid-1800s. Milestones like the completion of the Transcontinental Railroad connecting the US East and West Coasts in 1869 fueled the interest in railway investment. This was not only true in the US but also in Europe. For instance, railway companies financed by debt popped up all over Germany. Railroad stock prices jumped worldwide. Many banks held railway bonds as an investment. A key vulnerability of a country's banking system became railroad bond speculation. Indeed, railroads needed a lot of upfront investment and produced little or no return in the early years, presenting the risk to investors. There were a number of contributing factors that eventually led to the burst of the railroad speculation bubble. For instance, the Boston and Chicago fires right before the crisis reduced bank reserves. Germany and the US abandoned silver currencies, which put strains on miners and reduced the need for railroad networks. And dislocations from the Franco-German War were still present. The first signs of the crisis became visible in Vienna, where the stock exchange crashed on May 9, 1873, and a series of bankruptcies followed. In Germany, a large railway company collapsed, adding to the panic. In the US, J. Koch and Company, a major bank, was unable to sell railway bonds. It collapsed mid-September, sparking bank runs and failures across the US. A prominent victim of the US banking crisis was the Freedmen's Savings Bank. This was the first and only bank at the time that served the free former slaves. The US and the Europe plunged into a deep recession, with unemployment rising fast. This crisis also affected the Ottoman Empire and Latin America. All told, this crisis originated in speculative investments, railroad bonds, that led to large losses and a lack of trust in the banking system. A different type of investment, namely government debt, sparked the so-called Barings Crisis of 1890. By 1890, Argentina had experienced a decade of large capital inflows. The capital was raised mostly in London by European banks, including Barings Bank. The money was used to finance long-term investment projects in infrastructure, including the building of railroads and transportation networks and the improvement of farmlands. However, by the late 1880s, as much as 40% of foreign borrowing was going to debt service, and 60% of imports was going towards consumption goods. The Argentinian government was also running a substantial budget deficit. Railway net profits had peaked in 1888, and eventually international investors became wary of Argentina's government's debt burden. Eventually, Barings could not find investors for Argentina's debt issuance. Argentina experienced bank runs and, unable to raise new funds, defaulted on its government bonds. This default led to a sharp recession in Latin America, but also to sharp stock market drops in Europe and the US. As with the 1873 crisis, a credit boom to speculative long-term investments eventually turned bad. But note the international linkages. The speculative activity was fueled by international investors. The next crisis, the Panic of 1907, originated in copper speculation. Since we discussed the Panic of 1907 in a separate lecture, I will be brief. The San Francisco earthquake caused large losses for insurance companies, railways, and banks. Against this backdrop, speculation in copper equities gone wrong led to even more losses in the banking system. This led to a banking panic, bank closures, and a recession that spread from the US to Europe. In the US, the unemployment rate rose to over 16%. Global markets were also hit hard. For instance, the British unemployment rate doubled from 3.6% to 7.8% between 1906 and 1908. Germany, Japan, and Italy also experienced bank runs. The Panic of 1907 is an example of financial market speculation gone wrong. However, the effects are similar to other crises. Bank losses cause bank runs. Then, the disruption in the banking system caused credit and the real economy to contract. Here, too, there were international linkages. This included overseas exposures to insurance companies underwriting disaster risk in San Francisco, and also risky stock market bets by foreign investors. This allowed the crisis to spread from the US to the rest of the world. The Great Depression provides the clearest example of the importance of international linkages. Since we discussed the Great Depression separately, let me just focus on the international component. In 1929, when the stock market crash in the US triggered the Great Depression, most countries were on the gold standard. The gold standard meant that all paper currency was convertible into gold, and gold reserve therefore dictated the money supply. This also meant that most countries operated at a fixed exchange rate system, as each currency was fixed to gold. At that time, the US was a net lender of gold in the global markets. However, when the banking crisis unfolded, the US hoarded gold rather than lending it out. This left other countries scrambling to maintain their gold reserves to avoid a decrease in their respective money supply. A lower money supply put strain on banks and led to deflation around the world. For instance, the German Reichsbank basically ran out of gold when short-term creditors stopped lending to Germany. In the end, the gold standard was abandoned to allow countries to control their own money supply and avoid bank runs and deflation. In a nutshell, the Great Depression was transmitted through the global financial system because of fixed exchange rates. So, different from earlier financial crises, the issue here was not a common exposure to a bad long-term investment. This time, all currencies and all money supplies around the world were linked. With floating exchange rates, the value of the currency adjusts when facing an international shock. With fixed exchange rate, the money supply must adjust with large negative consequences. That brings us all the way to the 2008 financial crisis. You might now see how similar this event was to past crises. The crisis originated in the US housing market. Also, many other countries such as Spain and Ireland had also experienced a housing boom and bust. Many long-term mortgage investments funding the housing boom were financed by short-term credit. Once this short-term credit dried up, the mortgage market and house prices collapsed. As in previous financial crises, international investors had gained exposure to these investments. The extent to this exposure became clear when a mid-sized German bank, the IKB Deutsche Industriebank, failed in June 2007 due to losses from US subprime mortgages. In addition, it became apparent that domestic players, most notoriously the investment bank Lehman Brothers, depended on short-term funding secured by mortgages. Lehman Brothers suddenly collapsed in fall of 2008. So did the largest insurance company, the American International Group. This triggered a stock market crash and panic in the funding markets worldwide. In 2008, the crisis unfolded worldwide because of the globally integrated financial system in which capital flows freely across borders. A globally integrated financial system helps when shocks are small, as they can be absorbed easily. However, a shock to the largest economy impacts everyone. Before we wrap up, let's consider one final question. Do credit booms always lead to financial crises? The short answer is no. Recent research shows that many credit booms do not result in financial crises, but instead can have sustained economic growth. This chart shows output dynamics before and after the peak of a credit boom for a sample of 189 countries from 1910 to 2014. The peak of the credit boom is indicated by event time equal to 0, the vertical line. There are two lines indicating two different types of credit booms. Roughly speaking, one is in construction and real estate, the other is in the manufacturing sector. What does this graph show? Well, on average, GDP grows strongly during the boom. However, after the peak, output only seems to decline after a real estate credit boom. Why does this happen? Typically, a real estate credit boom increases house prices, construction of new homes, employment, and so on. However, eventually, there will not be enough local buyers to sustain the boom. This will then put downwards pressure on house prices, which can lead to a collapse in the construction sector. In contrast, credit booms in the manufacturing sector can be more sustainable. This usually happens when they are driven by global demand or demand for new products. Think about the fast increase in manufacturing in South Korea from the 1960s to the 1980s. Most of these products were exported. Credit to the manufacturing sector can fund profitable investments. These higher profits help to pay off the debt incurred during the credit boom. Let's wrap up. In this session, we have described the common features of financial crisis. They include excessive debt, especially short-term debt, long-term investments that eventually go bad, or some unsustainable government policy such as excessive spending or fixed exchange rates. We also saw how some financial crises became global in nature. Last, we saw that not all credit booms lead to banking crises or drops in GDP. Historically, credit booms in the manufacturing sector have been more sustainable.